Coming up on the SBS On the Money podcast, fuel habits are shifting. Are we getting enough workplace AI training? And the market's still rising. All of that and more next. Hi everyone, welcome to the SBS On the Money podcast for this Thursday, the 9th of April 2026. It's a day where the Australian share market rose by 0.2% after a spectacular rally yesterday. We'll have the details with Nick Schoenmaker from Portfolio Construction Forum in a few moments as we go into more detail of the top consumer finance and market news stories covered during On the Money on SBS World News. We also asked the question today, are workers getting enough at-work training for the likes of AI? But first, it appears Australians are changing their spending habits at petrol stations as fuel prices remain elevated, with motorists topping up instead of filling up. New research from NAB reveals consumers spent 53% more on fuel in the final week of March compared with February, but the number of transactions was also higher, up by 11%. The research relates to the period just before the Easter break and the government's reduction in the fuel excise of April the 1st, but oil prices are still 40% higher than where they were before the war. For more, I spoke with NAB senior economist Taylor Nugent. Taylor, to what extent are consumers spending more now on fuel and why?
Yeah, so we have certainly seen a big jump in fuel prices. We know that prices have gone up around 50% from where they were in February. And what we've seen in our spending data that we can see from our aggregated transactions is that in the week to the 28th of March, spending was about 53% higher than what we saw in February on fuel. So this is a little bit of a combination of higher spending, higher values, but also more transactions. So maybe there is a little bit of evidence there of consumers filling up a little bit more often, whether that's some evidence of hoarding to get ahead of price impacts, but also just with the cost going up, people might be filling up a little bit less per transaction to try and keep the cost down or topping up a little bit more often. But overall, a big jump in fuel spending, and it really is that price impact that's flowing through.
Okay, what about the rest of the economy? How has the war impacted spending patterns?
Yeah, and this is a big question at the moment. We know that fuel prices have gone up. We can see that, and fuel spending has gone up. But the big question is, how much is that creating what we call demand destruction? How much is that making people pull back in other areas of their spending? And this is something where what we can see, it's less obvious than what we can see in fuel. But we do think there is some evidence that discretionary spending, whether it's things like services, we think about restaurant meals and other things that are more discretionary, but also discretionary goods spending, it does seem like that's tracking a little bit slower through March and over the course of the month than what we've seen in previous cyclical patterns. So it does seem like there is a little bit of some sign of some pullback in other areas. Where there's been a more obvious drop in spending is in kind of travel and accommodation spending. And so a lot of this reflects refunds being elevated. And so that's this disruption from flights, especially through the Middle East, means that there was, a bit of a surge in spending because of, booking alternate travel arrangements at last minute, but then some money coming back in terms of refunds. So there's been some volatility there, but overall, it does seem like consumers certainly are seeing some slowing across broader spending.
Overall, how are consumers feeling at the moment, and to what extent has it changed to pre-war times?
Yeah, so this is something that it's difficult to track how consumers are feeling. It's a fairly it's not a particularly precise concept, but we do get some evidence of this both from their behavior. So we can see that they're pulling back a little bit at the margin in our spending data. We can also see through surveys of consumer confidence. And so the most timely evidence of that, the most timely surveys we see is that consumer confidence has fallen back. That's not really a particular surprise given the shock, given what they can see at the petrol station when they go to fill up and how that flows through. And so the big question looking forward here, and something that the RBA will be very focused on, is does that pessimism, if you like, translate through into a big pullback in other spending? Because one thing that we saw a lot during the pandemic is consumers are saying that they're very unhappy, consumer confidence is very low, but it's because inflation was high and they don't like prices going up. The important thing from the RBA's perspective is, does that mean that consumers are pulling back on spending, or do they just not like it because they have to wear those price increases?
So speaking of the RBA, What do you think this all will mean for monetary policy?
So the RBA, they're caught like all central banks are between, this is a supply shock, if you like. And so it pushes prices up, but it also is going to feed through into some slowing in activity growth and in demand growth. And so they're really looking at two sides of this with a slowing economy, but also an inflation problem. And so what that means is that the RBA, they're not going to have to hike into this aggressively as if this was an inflation surge driven by strength in demand. But we do think that the RBA cannot just kind of sit on the sidelines here. The starting point for Australia is a bit different to some other central banks. And so if we look across the last month or so since this conflict started, you look across advanced economy central banks around the world, the RBA is the only one who's tightened monetary policy. Everybody sounded a little bit more cautious, a little bit more concerned. They were monitoring inflation and worried that it would become a more persistent problem, but none of them actually hiked. And the difference there for us is the starting point. The domestic conditions in Australia already meant that the RBA probably needed to tighten a little bit further. They moved up to 4.1% in March. Our expectation is that they'll increase interest rates again to 4.35% at their May meeting in about 4 weeks' time. But when we think about the risks around that, it really is that balance between the inflation risks on one hand and the growth risks on the other hand. And so if we fast forward and those channels that could mean that households pull back, businesses stop spending, really become front of mind, that could be, a leg lower in asset prices, a re-flaring up in the conflict that sees that flow through, consumer spending measures, showing some signs of kind of collapsing, not just slowing. That could mean that the RBA sits on the sidelines. Similarly, if we don't get as much of a demand hit, if consumers kind of use savings balances that are there to kind of smooth through this, then what we would see is that the inflation problem becomes the more challenging one than the growth problem, and the RBA might need to do a little bit more. But so we think one more increase in May.
That's NAB senior economist there, Taylor Nugent. Okay, let's move on. And fewer Australians are upskilling, blaming too much work and not enough time, hindering future career growth prospects. The Bureau of Statistics says participation in work-related training fell to 19% of people last financial year, compared with 23% 4 years earlier. Financial reasons were another barrier to work-related training. 1 in 6 people incurred personal costs for their most recent work-related training. So should employers play an even bigger role in promoting worker education, especially in AI? I spoke with Karen Lonergan, Chief People Officer at PwC.
I think we've got to come at it from both ends of the spectrum. We've got to look at the responsibility that employers have, but we've also got to look at the responsibility of individuals in a rapidly evolving world of work to continue to invest in our own skills. From an employer's point of view, I think we have a responsibility to be pragmatic and understand that our people are leading really busy lives and have a lot of work on. So we have to make training efficient, effective, build it into the flow of work as much as possible. And then for individuals, I mean, back to your point, we can always make the excuse of too much on, but we have to invest in ourselves given the amount of change that's occurring and the productivity imperative for Australia.
You mentioned that change. We're in an environment where AI is really making waves across every industry. How important is it to make sure workers are being skilled up, and what proactive role, you were talking about it there earlier, can employers make and need to play in this?
So upskilling is absolutely the essential path through all of the change that AI is bringing for us in the workplace. The pace of change is different in some places than others, but everywhere, every occupation is changing to some extent. What I think is most critical from an employer's point of view is to not just think about the technical skills. AI is not just about technical skills. In fact, it's much more about the human skills, because that's the differentiating skills that we typically find. So a firm like ours is very focused on all of the AI training we're providing is very balanced between the technical skills and the human skills that get even more important, things like curiosity and judgment, empathy, those kinds of things.
And finally, what about those employees that may feel like they are not being given the opportunity to get those skills or get training, especially if they're in smaller organisations?
Yes.
How can they approach the conversation with their bosses?
Yeah, I think people in large firms like ours are very privileged. We have access to really, really good quality content and time to do it. My advice to people in smaller firms is to take that personal accountability, not wait for your employer. Raise questions with your employer around. I think there's a way of us improving our productivity. If I had some more training with these AI tools, I think together we could create a better outcome for our customers. We can create a more productive work environment. In some really small businesses that just won't have the ability to skill up, I'd be saying to employees, take the mantle for that yourself. There is lots of really quite good quality either low or in fact no cost training options out there through online platforms. A lot of the big tech providers have really good stuff that people can access at very little cost. So I'd really encourage people to be getting on with that themselves, as well as I said before, continuing to build your human skills, because that they're not going away anytime soon.
That's Karen Lonergan there from PwC, Chief People Officer. Let's move on to the Australian share market now, which extended on yesterday's spectacular 2.6% rally. Today, the ASX 200 up 0.25%. Energy stocks did best as investors continue to assess the fragile situation in the Middle East. Financial stocks also climbed, led by Bendigo Bank, after it announced some tech deals which will help it cut costs. The IT sector was the worst performer as many stocks gave back some of yesterday's gains. So with the index now just 3% away from a record high, how confident are investors? For that, I spoke with Nick Schoenmaker from Portfolio Construction Forum.
I mean, markets are kind of 2 to 3% off all-time highs despite a 6-week war. So it feels a little bit counterintuitive. We had, I think it was 9% wiped off the ASX. It's about $300 billion, which, to answer your question, tells you it feels like some confidence is there. But what I would say, Ricardo, is it's not conviction. It's relief and positioning, not fundamentally driven. I think there's been this narrative creep that people have been trying to figure out about what this war means. So we've seen very strong rallies driven by short covering, not new capital allocation. So that pertains to the question around confidence. And markets are effectively saying this is less bad, but it's not resolved. If we think about the disconnect in markets, equities, as you've alluded to, are kind of resilient, but the oil price is still, I think it's about 40% above pre-war levels. So confidence, I would say, is best described as fragile optimism, driven by liquidity and headlines, not really kind of clarity on where this still ends or when it ends.
What do you think this all means for global interest rates then? Overnight, we heard from the US Federal Reserve in its minutes. It showed a bit of an openness to rate hikes in the March meeting. So are rate hikes on the agenda in the US? Because that wouldn't make Donald Trump pretty happy.
It certainly would make him very happy. But we have seen a lot of the cuts that were priced into the market at the beginning of the year move into hikes, and that happened really quickly, particularly in Europe and the UK to a lesser extent when the conflict started, because they have a lot of exposure to natural gas, for example. But one thing to think of related to that question, Ricardo, is when you've got higher oil prices, that does some of the tightening for central banks. So if you're thinking about inflation pressures coming from energy, what that does is obviously pressure growth or GDP to the downside. Consumer spending starts to decline, and you get these stagflationary type impulses where you have higher costs but weaker demand. So markets have shifted from rate cuts to now debating rate hikes. And if I was to conclude with that, you have to think about how central banks are pretty constrained. They can't cut aggressively because you've got inflationary impulses. But it's going to be difficult to hike due to growth falling because of stagflation. So base case, that is, I think, rates stay higher for longer and policy really becomes reactive and not proactive because it's a supply-driven shock.
Over the past couple of weeks on the podcast, we've been obviously focusing a lot on the war, right? And so AI has taken a bit of a back seat, even though AI is all we were talking about last year. So I want to bring AI back in if we can today, right? AI in jobs in particular. We heard from Bendigo Bank today, who said it's going to cut some of its workforce as it steps up AI and technology with 2 new deals, which will save the bank around $75 million a year. What we don't know is how many jobs will go, but it follows huge cuts at the likes of WiseTech, Atlassian and Block in recent months. I'm keen to get your take on the AI story, the impact on the workforce and what it means for investors overall.
I mean, it really is a whole new world that we're in if you think about geopolitical fragmentation and the disruption from AI. I think the key shift with the AI story is that we're moving from a productivity story to what you're describing, which is really a economic disruption story. And we have started to see that, as you say, through tech, but also through banking. The way that we think about it in a portfolio construction context is what are some of the second order effects? So AI is driving massive demand for physical infrastructure, power, data centers, grids. So it's not just the software vulnerability that we've seen. And we have started to have now this new theme of halo, so moving from asset light tech to heavy assets in the market and infrastructure. So I think that's a new theme to keep an eye on. So there's been oversupply of software. We've seen valuation compression in that sector. So from an investor perspective, I think AI winners now aren't just the platforms per se, but they're the enablers, energy, infrastructure, materials, and how much disruption comes in white collar work. I mean, it's to be seen, but it could be everything from accounting to legal to everything. But making highly skilled people exceptionally skilled if used the right way.
And finally, in wrapping up, what are you telling your clients right now, and where do you see the opportunities for investors?
So I guess what we're doing at the moment, given there's such narrative creep coming through the market and really unprecedented territory, we are in a whole new world again, is thinking about how do you build resilience when the shock becomes potentially structural and not cyclical from a supply side perspective. Our portfolio is actually exposed to physical market stress. So energy supply chains are not just price volatility, what we typically think about. And then also what we've seen over recent times is traditional diversifiers in a multi-asset context like bonds haven't been working when bond yields spike up with energy prices going up, 1-year inflation expectations have gone up quite high and shares have fallen. And despite gold being really well bid for the last few years, it's been quite unreliable. And the US dollar and cash have really been the only kind of reliable hedges. So we're thinking about how do you layer hedging at the moment? And importantly, the granularity around our portfolio's position for regional divergence, because you've got energy producers versus energy importers. And obviously, with what we've seen, there are parallels in some ways to the 70s supply shock. So how do you think about commodities, infrastructure, real assets? Should they be tactical? Should they be strategic? How do you value them if they don't have income? So these are the practitioner debates that we are having in the market, and it's really about how do portfolios behave under a different type of stress where diversification is harder to come by, and correlations that we've relied on in the past are really a lot less stable.
That is Nick Schoenmaker there from Portfolio Construction Forum, and he wraps up the podcast for this Thursday. Give it a like, subscribe, and leave a review if you enjoy it. It's SBS on the Money podcast. Yes, on the money during the 6:30 edition of SBS World News weeknights, and the podcast returns tomorrow. It drops after the market close every weekday. See you then. This SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.